Even briefly, India's tech services feel the ripple, could disrupt capital inflows. Corrections may not be over yet. In asset quality, private banks stood up. Strategies now. We should avoid naked option strategies in the market anymore, whether it's each. What happens in the US or in China isn't just business anymore. Every tick in the crude, every yield spike, every trade tariff eventually knocks on the Wall Street door, isn't it? But the key is not to panic, it's to understand the chain reaction. In the next few minutes, I will take you through what moved globally last week and how these silent tremors will shape India's market behavior in the next 1 to 4 weeks. Let's connect the dots. Hi, this is Prabhanjan Rao from Elysian Investment Advisory. We are a SEBI registered investment advisory providing curated solutions to long-term wealth creation, lifestyle planning, retirement planning, estate planning. I am also a chartered accountant and a cost and management accountant having more than 22 years of experience in the similar field. Disclaimer: the following content is for the information and educational purposes only. It should not be construed as an investment advice. Please consult your financial advisor before making any investment decisions. What are we going to discuss now? We are going to discuss 3 sections. Section 1, global tremors and why they matter to India. In the second section, how India absorbed the shock. In the third section, what to do in the next week and next month. So stay tuned till the last section of the video. Now, let's get on to our first section, global tremors and why they matter to India. The US is flying but dangerously high. S&P 500 and Nasdaq hit record highs. Why? Just 5 tech names: Nvidia, Amazon, Microsoft, Broadcom, Meta. These names account for over 50% of the recent S&P gains. Why this matters to India? Indian IT companies depend on US tech and BFSI budgets. If these 5 giants pause, even briefly, India's tech services feel the ripple. You're already seeing it. TCS posted soft Q1 numbers. The reality is, the tech supercycle hasn't returned yet. Then what should be our strategy? Avoid super exposure to IT. Wait for Infosys commentary. Short-term pain is very likely. Disclaimer: any stock name mentioned in this video is purely for educational purposes and my view is very short term. So please consult your financial advisor for investment advices. The US tariffs are back. The silent shockwave is 35% tariff on Canadian goods, 25 to 50% tariffs proposed on Japan, Korea, and also on the pharma, copper, and more sectors. What it signals? The US is heading into an election mode and tariffs are a tool. Global trade friction is about to rise. Expect countermeasures. And what is India angle in this? Short-term pharma exporters could gain if India fills the gaps in the US supply chains. But global uncertainty still looms. FIIs are cautious and corporates are also cautious in their investment strategies. And what should be the strategy? Select innovation-led pharma, avoid index-wide bets. Tariff tension could disrupt capital inflows. Now let's understand US bond yields, how they are rising, and what is the dollar at 97. The 10-year yield climbed to 4.35%, 30-year yield at 4.86%, and interestingly you see this, the dollar index is very stable around 97. What is these parameters imply for India? Risk of globally, less money chasing emerging market debts. Indian bond markets see upward pressure. RBI might delay easing even if the inflation looks under control. And what should be our play? We should stay very cautious on NBFCs and rate-sensitive sectors. We shouldn't chase REITs or infra plays until rate clarity returns. When the dollar index crosses 100, what happens then? Right now, the dollar index is sitting at 97. But if it inches above 100, that's just not a number, It is a signal that the risk is coming off the table globally. When the dollar strengthens, global investors run for safety. That means money leaves emerging markets like India and flows back into US bonds and dollar assets. What is the impact on India? Obviously, the FII outflows, rupee weakens, imported inflation, interest rate dilemma. And what should be the action if dollar index is more than 100? What are the sectors that might outplay? Is IT, pharma, a positive exposure to USD. FMCG, there will be a margin pressure from input costs. NBFCs, PSU banks, since they are exposed to FII pullouts, they also experience funding costs. Now, crude oil is nearing $70, from $67 to $69 quietly in a week. Market isn't it worried yet? But for India, every $5 move adds pressure to the current account. Margins of aviation, logistics, and paid companies are directly exposed. So, avoid paints and budget airlines. Prefer export heavy businesses that can absorb cost pressure. Now, the most interesting topic, Bitcoin. Viewers, Bitcoin is rising to $117.8 thousand, driven by institutions. It's not just the hype this time. What is the India angle in this? Retail investors shifting liquidity into retail digital assets again. It could hurt small cap equity flows temporarily. Just watch this for now. But when crypto surges, risk assets often stretch thin elsewhere. Now let's move on to our second section, how India absorbed the shock. India is likely to remain in a consolidation zone for a few more weeks. Multiple domestic triggers, IT earnings uncertainty, regulatory tightening, and selective sector corrections are overlapping with global risk factors like rising yields and a volatile dollar. Corrections may not be over yet. Institutional flows are turning cautious. Patience and sector rotation are the key here. TCS and IT weakness. A warning, not a blip. Q1 numbers are underwhelming. Clients aren't spending as fast as hoped. Global caution is real, especially in the US BFSI. So, what to do now? So, we need to cautiously wait and watch out for the mid-tier IT numbers and their guidance. The impact of Jane Street because of SEBI's actions. 4,800 crore frozen, index manipulation alleged, option volume dropped by 40 to 50%. And what is the implication? Lower liquidity, more regulatory scrutiny, broker valuations took a hit. What should be our strategies now? We should avoid naked option strategies. Defense. Rally is paused for now, but not over. No fresh contracts and stretched valuations leading to profit booking. What should be our smart move? Watch for the export contracts or budget allocations. Due to strong asset quality, private banks stood up. Similarly, discretionary, the premium consumption held ground. Healthcare, innovation-led pharma is rising. Industrials, continued infra push and export support has given them a very good ground. Now, let's get into the third section, what to do in the next week and a month. Where to park your funds? So, I have classified this by risk appetite. If your appetite is of a low risk, then park in private banks, which has a stable growth, low NPAs. Medium risk, park your funds in healthcare, which are driven by innovation, but it has a tariff tailwind as well. If your risk appetite is an opportunist, then park your funds in industrials. Of course, you have a policy tailwinds. Avoid mid-cap IT, small NBFCs because they have a margin squeeze. Of course, these are our short-term recommendations. What should be in your watch list? Select discretionary. Hold up on the domestic demand. Now let's wrap up. There is no such thing as a local market anymore. Whether it's a Powell's speech or a Beijing policy tweak, it all flows into Mumbai. Don't watch the screen, watch the trend. The real risk this month isn't collapse, it's complacency. Final thoughts? Follow the flows, not the noise. Focus on sectors with visibility. Be patient. Volatility will give you better prices. Like what you heard, subscribe and share. Again, disclaimer, this is an educational market commentary. No stock recommendations whatsoever are made. Please consult your financial advisor. Do subscribe, like, share and comment. Have a super Elysian day.